All right, good afternoon, ladies and gentlemen. My name is David Tam. I'm the chair of the Funds Commission. Welcome to this May 23rd meeting of the City of San Diego Funds Commission. We're going to do a quick roll call to confirm commissioner attendance. When I call your name, please say present. Commissioner John Peel, present. Commissioner Colin Dowd, present. Thank you. Your attendance has been noted. For the record, we have quorum consisting of Commissioner John Peel, Commissioner Colin Dowd, and myself, Chair David Tam. Also present are Allison Bonney from Northern Trust, Silva Thomas from Northern Trust, Jeff Knipp from Siegel Marco Advisors, and Jeremy Shortis, Office of Boards and Commissions Liaison. So we'll get started with the approval of the minutes for February 29th, 2024 Funds Commission. Are there any changes to the minutes that were provided? Hearing none. Is there a motion to approve the February 29th, 2024 meeting minutes with the changes brought forward?
Motion to approve.
Okay, I'll second. And we will now take roll call to count the vote. Motion by John Peel, second by Chair David Tam. We'll now take roll call to count the vote. Commissioner John Peel.
Aye.
And Commissioner Colin Dowd.
Aye.
And myself, I vote aye. That motion passes unanimously. Okay, now let's move on to the informational items in the agenda. We'll take up item 1, report from Northern Trust regarding the Mount Hope Cemetery Fund investment and performance review. I will now hand it over to Allison Bonney from Northern Trust to present this item.
Thank you very much, everyone. Can you hear me?
Yes.
Yes.
Great. Okay, well, I am going to have Jeremy is going to assist me today in sharing the slides. So we're going to start on page, which will be, let me just make sure I can see the page numbers on this view here. Page 4. Okay, so this is first quarter, and as usual, things have a way of changing very quickly in these markets. So while I will review what happened through the end of the first quarter, to the extent I can provide some insights since that time, I absolutely will. Coming off of 2023, 2024 got off to a little bit of a bumpy start, but overall really had some excellent returns. So we saw the S&P up almost 10.5, close to 11%. And international and emerging markets were also in positive territory. So overall, the markets continued at that point in time to react positively to corporate earnings, strong market employment markets, strong consumer confidence, better than expected growth, but also inflation numbers that were still trending in the right direction, i.e. coming down. And so that was the basic story during the first quarter of 2024. And it was during that period of time that Northern had a slight overweight to risk assets. If you'll recall, your portfolio was very much overweight risk assets, and we did bring that down during the end of the first quarter. And I believe I was asked that question in our last meeting, and I said, we're going to sort of look at it in a day-by-day basis. And in fact, given the strength of the first quarter, we did de-risk the portfolio slightly. Page 5 kind of will give you a sense of what happened in January. So a little bit of a rocky start, but then the market took off through the balance of February and March. And again, led by a lot of the positive aspects of growth, the Mag 7 stocks, you name it, it turned out to be a very solid first quarter. Page 6 just shows you some of the dynamics from a macroeconomic point of view. On the left-hand upper corner, you'll see that the U.S. both 3-month and 6-month consensus for GDP was relatively high. Just so you know, these numbers have sort of come in this direction. Europe, UK, Japan, and China. Europe and Japan sort of flat to slightly negative expectations. China pretty much flat. And up on the right-hand side, you'll see after a bumpy ride up from 2019 through 2022 in inflation, we saw various inflation measures, whether it's core, PCE, coming down. Now, we did see towards, and this is what you're looking at the far right-hand side, some of those numbers, the 3-month annualized numbers starting to tick back up. And that became the story as we went into April. The lower left-hand side is simply showing you what the expectations have been so far for policy changes for central banks globally. Nobody had made any changes thus far except for Japan. And then over on the right-hand side, we see, looking at it, the S&P relative returns, whether it's equal weighted, meaning we're sort of discounting the performance of the Magnificent Seven and just looking at all of the companies in the S&P 500 versus looking at cyclical sectors and looking at small cap stocks, the Russell 2000. The Russell 2000 doing the worst. If you go over back on the left-hand side, it's interesting to see that equal weighted, independent of what happened to the S&P, which was, I said, was up 10, we see that on an equal weighted basis, the S&P was actually negative during January and February, and then started to swing slightly positive in March. So the notion of the Mag 7 and what companies populate or driving that S&P strength, it's coming from those top tech stocks. And more or less, we've seen it kind of wane and wax as far as the impact of those companies. In general, they are still leading the charge. So in summary, on page 7, you will see by asset class how various asset classes did. Over on the left-hand side, we can look at fixed income and primarily risk control assets. We saw them swing slightly negative, and that had to do with basically interest rate fluctuations. So whereas in 2023, investment grade bonds, which includes both governments and corporates, came in at 5.5%, as of the end of the first quarter, they were negative about 1%, and tips were flat. And high yield bonds, slightly positive. If you go over to the right-hand side, again, you can see that whether it was the U.S. developed markets or emerging markets through the first quarter, all positive. Again, not as positive as they were in 2023, but still, again, moving in the right direction. And finally, on the far right-hand side, you'll see within the real asset class categories, real estate continues to struggle. Any questions here? Okay, so as of the end of the first quarter, Northern was tactically recommending in client portfolios that we stay slightly underweight cash, that we overweight high yield bonds because of a preferred risk-adjusted return positioning, and that we stay neutral all other asset classes. I will tell you right now that as of the middle of May, and we're still implementing these and looking at your portfolio included, Northern has recommended adding back to core equities, basically about 5%, and also keeping the overweight to high yield bonds, but taking away from natural resources, given the declining growth in the economy. The sense right now is that natural resources, independent of what the volatility within the energy segment, may not outperform as we perhaps had expected based on their performance several years ago. And so the overweights now that we're putting in place for client portfolios are being taken from investment grade bonds and global natural resources. You will see that material next quarter, but that's the direction we are now moving in. As far as our base case and risk cases, these haven't really changed. I mean, we are still anticipating a sticky landing. Growth is declining, but it's declining, but it's still positive, so it's decelerating. But moving again, and especially after the numbers we saw last week, it looks like inflation may be, at least with CPI, which ticked down last week, moving in the right direction towards 2%. In terms of central bank transitions, there's a very broad dispersion in terms of consensus on the street as to when and if rate cuts will take place. Northern Trust currently is in the 2 rate cut camp, starting sometime in mid to late September. The stubborn inflation case is our biggest risk case in portfolios, that in fact we are not successful, or the Fed, et cetera, are not successful in maneuvering inflation back down. Shelter costs, other geopolitical dynamics going on in the world, all keeping inflation above where we need it to be longer term. The other risk case is that we're going to have some lagged impact from on the economy and on companies for all of the rate hikes, and that earnings and margins will be hurt. That is not what we're observing right now in the middle of the second quarter, but it's always a risk case that we're looking at, which means that being neutral to overweight risk assets could work against the portfolio. Here is what the portfolio looked like as of the end of the first quarter. And as I mentioned during our last call that we would be starting to de-risk the portfolio, we did. As of the end of March, the portfolio was at 12.16 million. The numbers as of yesterday, and this is after the month of April, which of those of you who stay on top of the market, I think it was down, gosh, I should know these numbers off the top of my head, probably on a net basis, equities down 6 or 7%. Also, fixed income hurt pretty dramatically because of the negative or the other weak inflation numbers. So fixed income was hurt as well. Now, in May, we've seen this all reverse, so that the portfolio as of today is still at about I'm looking at the numbers here, 12.12 million. And your allocations are roughly the same as they are today. So we de-risked the portfolio. And I know that I said that right now we're looking to add back to risk assets. It won't be dramatic. We will likely add a little bit more back to your U.S. equities and your non-U.S. equities, and keep your high yield bond allocation in place. And again, those will be coming from natural resources, which, if we bring it down 1%, it's sort of meaningless, but it will come from your core fixed income portfolio.
So just a quick question. Where are we with the risk control assets compared to this chart here?
You're right where you are here on this chart in terms of the numbers.
Yeah, are we still about 58.9% risk control today as opposed to this March number?
Yes.
Okay.
Yes. So you are currently, the exact numbers, your equities are at 27.5. Your real assets are still at 4.1. High yield is actually 9. It came down a little bit. It's probably because of some of the strength we saw in the equity markets over the past week. And then your fixed income core is 52% and tips are 4. So you're right here right now.
Thank you.
Okay. As far as your performance is concerned, here's a summary. First, on the upper right-hand corner, you started the year at about 12 million. You've taken out 94 million, and that's a combination of fees, which were 94,000, excuse me. Fees were about 13,500, and you saw you had income of 72 and depreciation of about 200,000. So you ended the quarter at 12.2 million. As far as performance is concerned, you can see the greatest performance obviously is coming from your large cap equities, followed by international. And these are the year-to-date numbers, and then you've got your 1-year numbers. Again, I apologize, I'm on page 11. Your fixed income, we saw a little bit of weakness, as I showed on the first page, in terms of the asset allocation, asset class performance numbers, but your high yield was up. So overall, your fixed income has stayed in positive territory. The number that I generally look at is, where did your fixed income come in on a 1-year rolling basis? Now it's up north of 3%, which is, where we're hoping it's going to stay over the long run. And you can see on a 1-year basis, your high yield delivered 10%. So very solid risk-adjusted returns coming from your high yield. In terms of net performance relative to your benchmark down below, year to date, the portfolio is up 2% net of all fees, meaning both the vehicle fees and Northern Trust Advisory fee. Your benchmark, which is based on back to page 10, your IPS targets, we take each of those targets, we weight them by the appropriate index, that number is coming in at 1.85. So, before Northern Trust advisory fee, the right comparison would be the 2.25% versus the 1.85. So you are running ahead of benchmark in the near term. Any questions here? Okay. Let me just sort of give you a little bit more insight. Again, these are dated now from almost 2 months now, but in general, on page 13, I think the charts to point to, we think we know what's going on with interest rates. We've seen the yield come down. It did the 10-year, which is the number you want to look at. That, unfortunately, in April did pop back up to the 4.7 range, which drove net performance in your core investment grade bonds down. Again, that has reversed. If you can see over on the right-hand side, we've seen spreads gap in. We don't think that will go much further, but that was what was happening during the first quarter. But we're still seeing yields in the high yield market somewhere between the 5 to 7% range, depending on the quality. And so, again, we were maintaining an overweight to that asset class. And then you can see within on the lower left-hand side and lower right-hand side, the relative performance of both equities since December, as well as real assets since December. And the dotted line on the lower right-hand corner of page 13 is where global equities have come in relative to other real assets. So global equities outperforming real assets. On page 14, the story here really is if you look at, GDP, which I spoke to earlier, again, it's coming down, but we saw a spike come, beginning in January and February, and that's the US versus others that have come down. China is the yellow line along the top. Clearly, their growth is still positive just based on the size of the economy. But the US is inching back up towards where China is. And then in terms of core CPI momentum, again, this chart is showing you what's happening now. 2024, these numbers began to tick up again, but hopefully over the next probably 2 to 3 months, that will be the real indicator of where we see CPI and other inflation measures start to come down. Within the credit markets on page 15, again, a lot of people have been concerned that in the high yield market, there's going to be a lot of refinancings. They're going to hit the wall. It looks like the market has really been absorbing the supply of high yield bonds, and a lot of it is happening through the refinancing. So what's going on right now is companies who are holders or issuers of high yield bonds have been refinancing still at relatively favorable rates from an investor's perspective. So that's good news as an investor. And finally, within equities, cyclically oriented equities have done well, along with the upside in growth. But as I would say here, you will note that we still do have this general issue of, the top 10%, 15% of the numbers of the S&P companies still far outperforming equal weighted. Some of the anecdotes I can tell you so far in April is we have started to see a broadening out of the equity markets again. We see small cap stocks, doing well. We're seeing earnings coming in positive, and in fact, earnings growth so far this quarter, the stronger earnings growth is coming out of Europe and in emerging markets. So that's good news as far as having a well-diversified portfolio. Let me just see if there's anything else here I would point to. Let's just go quickly to, because page 21. So again, when you get down to a granular level, here are the investments you have. Again, this is by asset class. And then on page 23, you can go through and see what is in the portfolio. So we've looked to, so you'll see here within your equity portfolio, you've got Russell 3000. We put that into the portfolio in 2024, trying to bring down the fees in the portfolio. We also put you into a CRIS fund. So that comprises the 12% to date, but you can look across the top And what I was concerned about when I looked at this portfolio, if you look at the 1-year number, your large cap was underperforming relative to the S&P 500, which is why I looked to it and I said, you had too much growth. You had some other active strategies in there that were underperforming. So I moved you into these two index strategies to smooth that out. And you can see as you go down just the various vehicles that we're using in the portfolio with the eye towards continuing to bring fees down, trying to, take out any basically what I would call uncompensated risk in the portfolio to make sure you're getting, from a value perspective, the kind of performance you need. So on page 25, again, this is just an overall summary of how the portfolio has done. And I would encourage you, and we will be seeing the investment perspective, which starts on page, I don't know where this is in the deck, it's slide 48. If you have time, read this. The May issue has just come out as well. And I think it will tell you a different story in terms of what we're seeing now, in terms of, a reduction in upside surprises when it comes to inflation increasing. But again, I think we have a long ways to go for the balance of the year in terms of, where we will end up. But Northern remains, basically very constructive today into today's market climate. And I'm going to stop there and open it up for questions.
Are there any questions or comments from the commissioners, city treasurer, city attorney, or staff? No? Okay. Thank you for the update, Ms. Bonnie. Anything else you'd like to add?
No, I would like to say thank you for continuing our contract with you this year. Appreciate it. My colleagues on behalf of we say thank you and really appreciate your vote of confidence.
Certainly. Ms. Bonnie, thank you again for providing the Funds Commission with this report. Note for the record that this is an informational item. There will be no commission action. We will now take up items 2 and 3 together. Item 2, report from Siegel Marco Advisors regarding business and economic outlook. And item 3, report from Siegel Marco Advisors regarding the performance of the funds. I will now turn it over to Jeff Knipp from Siegel Marco Advisors to present these items.
Thank you. Jeremy, mine starts on page 62 of the PDF. For our new commissioner, let me give you a quick sort of recap of what's going on here. So the cemetery fund that Allison was just talking about has some special requirements. The investments have to generate income. These other 6 funds that I'm going to talk about don't have those requirements. So Northern Trust has discretion to manage that cemetery portfolio. They're picking the holdings within it, but they have to be guided by the income generating. All 6 of these funds that I'm going to talk about are invested the same way, the same investment policy. And it's a 65-35 stock bond, very simple. I think it's 40% U.S. equity, 25% international equity, 35% broad market fixed income. We've got a couple of funds. These are all mutual funds in each one. 3 of the 6 funds have quarterly distributions. So at the beginning of every quarter, Jeremy comes to us and we look at how the allocations are, and we'll take from the overweighted areas. The other funds periodically will need to do some rebalancing. We did it last quarter because they had gotten outside or high enough away from their targets, and not surprisingly, it was taking down domestic equity, bringing up fixed income. So what we do here is advisory. So the commission makes the decision on which funds to hold, and the allocations we advise, we report. So that's a quick background on what's going on. So the way we do our report, which it's pretty long, but the first part, and actually page 71, we took one of the 6 funds, this one, and we do pretty detailed reporting on it. And then we have the other funds similar, but not as much detail. And then at the very end of our report, the individual mutual funds, we have a page on each of those. So I just use this as an example, and I'll walk through what's going on here. Allison already did a good job of explaining what's been going on in the markets. So stocks up, bonds down, basically. And it's been interesting this quarter. And I think, as she was explaining, where you are today versus the end of March, it's been almost a classic V shape. April was ugly for stocks and bonds. May, things have turned around. So we're almost back to exactly where we were at the end of March. Okay, so the next page, page 72, just shows the allocations. This is one of the 3 funds that does quarterly distributions. So you can see at the end of March, we were close to 3% overweight in domestic equity. So when we did a distribution in early April, that's where we took it from. So we'll have similar charts on all the other funds, which I'm not going to go through. But because of the rebalancing that we did, the 3 funds that don't do distributions are actually closer to their targets because we kind of already took care of that last quarter. Next page just shows cash flow. So again, this one you can see in the quarter, 44,000+ coming out. That's mainly that distribution. And the size of these 6 funds ranges from a few $100,000 to $7 or $8 million. I think the biggest one, this particular fund is, you can see about $3.5 million. But again, there's a variety of sizes. And then the performance is on the next page. Again, all of these are going to be very similar. You know, they might be 0.1 or so different between the various portfolios. But it was a good quarter in both absolute and relative return terms, up over 5%, which was a little bit ahead of the policy benchmark. You've got an S&P 500 index fund, and despite the red coloring, it's tracking the benchmark just as it should. We've got active management for small and mid-cap domestic equity. Boston Trust had a nice quarter, outperformed by more than 1%. They've been in place now for a little over 3 years. If you look over to the far right, the since inception number outperforming by almost 4% at that time. So this has been a very good addition. Next page, we've got the international funds. So here we've got 2 funds. One is really the growth fund. One is really the value fund. This was a growth quarter. So the growth fund, the Europe Pacific Growth, did very well. So it's had a couple of good quarters now. It's still lagging a little bit from a couple of years ago in that tough 2022 period. But longer term results are good. Dodge & Cox, the value manager, on the other hand, this was not a value quarter, so they're lagging behind so far this year. But again, longer term, doing fine. And both of these are being measured against a broad market index. They're not being measured against a style specific index. But what we're trying to do here is just build in some diversification in the portfolio. And then we've got 2 fixed income funds down at the bottom. One is the Western, WAMCO. The other is new, Baird. So there used to be a MetWest fund here, and we replaced it last quarter for a couple of reasons. One was they'd had some portfolio management turnover, a couple of people retired or were going to retire. But the other was we didn't feel like we were getting enough diversification from Western, that they were tending to move in the same direction. And so we looked at some candidates and we selected Baird, or the commission selected Baird, which is a more duration neutral type of portfolio, not as aggressive as Western is. When Western does well, they do really well. When they don't, they don't. So we wanted to balance that with a little more conservative approach with Baird. So this was a quarter, again, bond market returns were negative. Western's got a little bit longer duration than the market. So sure enough, they were negative for the quarter. For the 1 year they're ahead, and that's because they had a blowout fourth quarter. They did great in the fourth quarter when rates came down. So it's a bumpy ride with Western. That's why we wanted to counterbalance it with a more conservative approach. And if you look at the gray line sort of in the middle where it says fixed income composite, you can see for the quarter, basically, you're right on the benchmark. So even though Western underperformed, the combination of the Met West fund that had been in there and the Baird fund, which came in place in March, so it's only been there, at this point of 1 month, that helped counterbalance some of that underperformance by Western. So we'll start seeing performance numbers for Baird next quarter once we have a full quarter. That was all I was going to say about performance. I've got a couple other things about a couple of the managers I just wanted to bring to your attention. But any questions on the performance?
Quick question on Dodge and Cox. The 10-year is negative. Am I reading that correctly?
Yeah, so they are behind the broad market index for 10 years, and that's very much a style thing. If you looked at them against the value index, they'd be ahead. They tend to run, both these managers actually, which is why they're a good combination. They tend to run between the broad market and whatever the style benchmark is. They're that in between. So we're not trying to get extreme styles, but we've got kind of growth oriented or value oriented, and it's just that style influence that's going to drag, because other than 2022, it's been a growth run for many years, and so they're kind of 3 and 5 year performance is definitely helped by how well they did in 2022. They have a lot of energy exposure in the portfolio. That was the only thing that did well in 2022, but that didn't help lately.
Do you still have confidence in the team?
We do, yes. Yeah, we have a lot of client use of this fund. One of my other clients just added it, in fact. So, other questions on performance? Okay, so I just wanted to give you a quick update on a couple of the managers. So Boston Trust, the small and mid-cap manager, they have a 4-person portfolio management team. The lead portfolio manager is a guy named Ken Scott, who's also co-CEO of the firm. He's getting towards retirement. He's not there yet, but as part of their succession planning, he's no longer going to be the lead manager on this fund. It's going to be another guy, Richard Williams, who's worked alongside him for many years. We know Richard and Ken, known them for a long time. Still going to be the same 4 people. It's just that Richard will now be the lead manager. So not a concern. And again, this is kind of the first step in the transition that Ken will eventually be retiring, but nothing has been announced in terms of that. He's just kind of stepping back from the lead role here. The other one I wanted to talk about was Western on the fixed income. So this is a 6-person portfolio management team. And I'm going to be careful in how I say this. Recently, they announced, so Ken Leach is the CIO of Western, has been for a long time. One of the other managers on the team, Mike Buchanan, was recently named co-CIO. So again, this is part of a sort of succession planning for Ken Leach eventually retiring. He's not there yet. Shortly after Mike Buchanan was named as co-CIO, another member of the portfolio management team, John Bellows, resigned from Western. I will not speculate as to why he might have resigned, but timing was interesting. So they're not going to replace him. It's now going to be 5 people managing the fund instead of 6. And in fact, what he was doing is a sort of they have various committees. He was the broad market committee. He had actually just taken over as head of that committee. The guy who had been the head of that committee is still on the portfolio management team. So he's just going to step back in to that role. So again, a lot of depth and experience there. Not something that worries us, but it was interesting timing. I'll just leave it at that. Now, just within the last couple of days, I got an email from the head of our fixed income research team. And he's been talking with Western. We have a lot of clients with Western as well. And they have come to us with the potential for some fee savings. I don't have details yet because I literally just got this a couple days ago. But for clients in the mutual fund, which you are, there may be, and I'm going to say may be an opportunity to move into a commingled fund vehicle instead of a mutual fund vehicle, which would result in a savings of about 10 basis points. Currently, the fee on the mutual fund that you're in is, I think, 43 basis points. This commingled vehicle, if that turns out to be available, and I'm still waiting on details, has a management fee of 30 plus administrative, kind of custody fees of 3 basis points. So go from 43 to 33, if that is going to be a possibility. Our research guy is going to follow up individually with those of us who have clients in the fund to let us know what's available, what has to be done to take advantage of this. So I don't have that yet. I think this should be available, but I want to wait until I get the details. But I just wanted to bring it to your attention. That's
Just clarify, is that just a different share class?
it's a different vehicle. So it goes from a mutual fund vehicle to a commingled investment trust.
Why would they want to do that?
We've done this with other managers where we have a lot of client exposure, and it's efficiencies for them basically that by talking with us, they cover a lot of clients, and so they're willing to sort of recognize that they're not having to do all this individual client service, and sometimes we push or suggest this to them, and it's good. It's a win-win for everybody. They don't have to do any extra work, but it recognizes the amount of business that they get through Sequel Marco.
And would it impact liquidity or holdings? Would there be a difference?
Yeah, so liquidity, I think the impact would be minimal, but this is part of the detail I need to get.
Okay.
Sometimes with a commingled vehicle, it takes a day or two to get your, if you want to make a withdrawal or do some rebalancing or something. So we'd have to look at that, but that's part of the detail I need to get. Holdings will be very similar, but slightly different because it is a different vehicle. There is a different portfolio, but they're all going to look very much alike based on their views. So just wanted to, again, I just got this, so I just wanted to bring this to your attention. More to come on this, but I think if there's an opportunity to basically knock off about 25% of the fees on this fund, it's worth looking at. Just for information, the Baird fund, the new one, is 30 basis points expense ratio. So if we could do this, this would bring Western down pretty close to where Baird is.
Would you send us that information before the next meeting?
I will.
Okay.
Yes.
Anything else?
That's all I have.
Okay. All right. Are there any other questions from Commissioner, City Treasurer, Attorney, or staff?
Yeah, I did have a question.
Jeremy.
So if that were to happen, is there the potential for having to update the investment policy statement?
I'll look at it. I don't think so.
Okay.
Because I don't think we talk about vehicles.
Okay.
We just talk about asset classes. Basically. Okay. Yeah.
I was just thinking as far as like from a efficiency standpoint for the next meeting, it's brought to the commission to vote on replacing that mutual fund with the CIT. Then if an update to the investment policy statement is needed as well, we can
do it at the same time.
Do it all at the same time.
And that's a good point. So I will look at all that once I've got more details.
Okay. Any other questions? Hearing none, Mr. Nick, thank you for providing Funds Commission with this information. Note for the record, this is an informational item. There will be no action. Now let's move on to the next item on the agenda, action items. We have 0 action items before the commission today. So let's move on to the next item. Non-agenda public comment. At each meeting, we invite public comment for up to 3 minutes about issues within the commission's jurisdiction, but not on the agenda. This afternoon, we have 0 speaker slips turned in for the non-agenda public comment. So that brings us to the conclusion, scheduling the next meeting. So let's determine availability for mid to late August for everyone. Maybe the 28th.
I can't do the 28th.
Okay.
I do the 29th.
I can do the 29th. Is everyone okay with the 29th of August?
I may not be able to do the 29th.
Let's shoot for a date. We can
This is
all-
always the most
yeah.
challenging part of
Yeah.
the meeting.
What about the 22nd?
22nd. I cannot do the 22nd. I can do the 15th.
Can't do the 15th.
Let's move into early September. How is September 5th? Oh, no. Yeah, September 5th is okay. For me.
That's good for me. It's fine.
Everyone okay with September 5th?
And I can confirm with Liz on her schedule for September 5th.
And Mara?
Do you know if there's anything special for city attorneys? Like,
I don't know, but I can check.
okay,
We'll send it out and see.
yeah.
Why don't we just shoot for September 5th, same time. What time did we do today? 1?
1 p.m.
And then same location, if that's okay.
Yes, I will check see if
Perfect.
this is available.
Okay, so this brings us to the end of the meeting. The next Funds Commission meeting is scheduled for September 5th, 1 p.m. Meeting adjourned at 1:42 p.m.
Awesome. Oh, and then just to add one other thing, which is that we had an appearance by advising attorney Margaret.
Oh, yes.